Today I want to share with you 22 lessons I learned in 2022 that I don't want to forget as a property investor, and I don't think you should either. You see, each year brings with it its own set of wins and challenges and lessons, and boy, 2022 was certainly no exception. It was an extraordinary year, wasn't it? Think about it, after 2 years before that of all our attention being focused on COVID-19 and the impact on our lives, last year, 2022, was the return of the type of concerns that consumed us before COVID started. Rather than the daily update counters of infections and deaths, we returned to our previous news diet of politics, elections, floods and sport, and unfortunately, wars overseas. And for most of us, it was also the return to our daily lives, our normal family lives, work lives, leisure, and, hey, vacations too. However, looking back at this time last year, who would have thought we'd have had 8 interest rate rises in as many months, or that inflation would be rampant, or there'd be a war on the other side of the world that would last for a year? Nobody could have foreseen all that happened, including the severe slump in consumer confidence because of all economic uncertainty. Or nobody would have thought coronavirus would keep lingering on. But now, as we're well into 2023, I can't help but reflect on what Australia as a country accomplished last year, what I achieved personally as last year, what a lot of our clients at Metropole achieved growing their property portfolio, and the things I've overcome, we've overcome, and the lessons that I want to carry me into this new year. And I'd like to share those with you today to help make 2023 a great year for you in your property journey. So let's get on and have a chat about the lessons I learned that I don't want to forget.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
At the beginning of every year, I sit down and I conduct an annual review. I've been conducting this self-reflection exercise for well over a decade now. Look, my goal is to zoom out to, 10,000 feet and take a macro view on the property lessons I learned or relearned in the previous year, and I'd like to share those with you today. Now, regular listeners of this podcast would know I have a guest on most shows, but today it's just me and you as I share with you my top 22 lessons from 2022. And I guess the first one I'd like to share with you is expect the unexpected. Every year has an unexpected, what I like to call an X factor, coming out of the blue to undo the best laid plans, sometimes on the upside, like the miracle election result of 2019, and sometimes on the downside, like COVID-19 in 2020 or the Delta outbreak in 2021, or the war in Ukraine in 2022 that caused inflation around the world. Now, strategic investors try and protect themselves from these surprises by owning the best assets they can, by having financial buffers in place to ride the ups and downs of the property cycle, by setting up the right ownership structures, insuring themselves, and obtaining holistic advice from their consultants. But the biggest risk is what no one sees coming, because if no one sees it coming, no one's prepared for it. And if no one's prepared for it, its damage will be amplified when it arrives. While an X factor seems to come every year, a major black swan event, as some call it, one that breaks the world, tends to happen every decade. So, my first lesson for you today is, even though you should make plans and must make plans, plan for your plan not to go to plan, because you can expect the unexpected. The second lesson I'd like to share with you is focus on the long term. The strong performance of our property markets remind us to ignore the numerous pessimistic property predictions of those so-called experts who predicted the real estate market would crash. Remember Real Estate Armageddon? I learned a long time ago that if you read predictions of last year and see how they transpired, you wouldn't pay too much attention to the predictions that are being made at present. In fact, you're going to learn a lot more from reading history than reading forecasts. And I guess that's a position I'm at now, having invested for virtually 5 decades, that I've seen it all before. The trouble is a lot of people giving advice over the last couple of years, and already this year haven't seen this sort of a cycle before. Now, of course, it's hard to ignore the forecast because the media continuously reminds us about how dire our situation is. But as you've heard me say before, I've also learned not to make 30-year investment decisions based on the last 30 minutes of news. Strategic investors have a long-term focus, and they don't change their plan on what's happening now. In fact, they don't buy investments that are working now. You're already seeing at this stage of the cycle people coming out and saying this is where you've got to invest now because of where it is, because of the time in the cycle, because of what's happening. Strategic investors invest in the type of assets that have always worked, not just those that work now. In other words, don't chase the next shiny toy. Don't chase the next hotspot. Clearly, this was the thinking behind Warren Buffett's quote when he said, "Be fearful when others are greedy, and be greedy when others are fearful." Now, while it's easy to say, I know it's not easy to do because human emotions are funny things, aren't they? The third lesson I'd like to remind you, and I've mentioned this in previous podcasts, is that it's the media's job to entertain you, not to educate you. Remember, it's the media's job to get eyeballs on advertisers' content rather than to educate you. However, just think about it a couple of years ago when the pandemic first hit. Many of us watched the 6 o'clock news and then the 7 o'clock news to see if there was something different reported, and then maybe the 7:30 report to get another angle on what was going to happen to our health, our economy, our property markets. And at the same time, my inbox kept dinging with alarmist messages that were uninformed or unbalanced. Think about it. How many of those experts' forecasts came true now a couple of years down the track? What happened to all those forecasts of the fiscal cliff or the unemployment cliff or the mortgage stress forcing floods of distressed borrowers onto our market? But have a look at how many people worried and stressed about the potential outcomes that just didn't occur. And we're hearing it again at the moment, aren't we? Unfortunately, being overwhelmed with misinformation in the past led many people to live in a state of fear and anxiety and caused some of them to make disastrous investment errors. Think about it. Imagine how much stuff you'd have to make up if you were forced to talk 24/7. Well, remember, that's what watching the financial news on TV or many of the media outlets is all about. So my next lesson is take economic forecasts with a grain of salt. As I said, remember all those forecasts? Remember they were talking about unemployment being 10% or more, and it's now got a 3 in front of it. What about all those forecasts only a year ago that property values would drop 20, 25, 30%? Yes, the market did fall in 2022. It does. That's just part of the cycle. And in some areas, property values fell more than others. But overall, our property markets were pretty resilient. And the year finished off with 6 out of 8 capital cities having higher median prices at the end of the year than at the beginning of the year. So all those forecasts didn't come to fruition, did they? What about all those country areas, regional areas that did really well as well? Similarly, if you're reading something frightening in the business section or hearing it on TV or learning it from your neighbour, it's actually probably, almost certainly, too late to act because the information's already reflected in the market, either in share prices or property prices. The problem with economic forecasting is the things you can predict tend not to matter, and the things you can't predict, they're the ones that make all the difference in the world. I'm on a bit of a theme here, a bit of a run here, as I share with you my 22 lessons from last year, from 2022. But the next one is don't believe the doomsayers, because there's always going to be somebody out there telling you not to invest in property. At the beginning of the pandemic, the doomsayers found their moment and told us how property markets would crash. They were wrong, of course. Now they're out again telling us about inflation and rising interest rates and mortgage defaults happening later this year that's going to cause the property market to crash again. Don't listen to these property pessimists and negative Nellies. These so-called experts looking for a headline who keep telling anyone who's going to listen to them that the real estate Armageddon is ahead of us. Now, there's nothing new about these doomsayers who've been peddling their forecasts for a decade or two. There's always going to be somebody wanting to stall the aspirations of their fellow Australians who are looking to take their financial futures into their own hands. There's always somebody wanting to stop them. These people, the average Australian, the average mum and dad who's investing in real estate to look after their financial future. Don't let them stop you achieving your financial dreams. The doomsayers are always wrong, at least in the long term. In my mind, predictions, opinions and forecasts should be discounted by the number of times the person making them is on TV or in the media every week. So my sixth lesson, and I guess it follows on from what we've been saying up to now, is no one really knows what's going to happen to the property markets. So be careful whose forecasts you listen to. There are 25 million property experts in Australia, and everyone seems to have an opinion about property, don't they? But you know what they say about opinions. They're like belly buttons. Everyone's got one, but they're basically useless. So as I said, be careful who you listen to. Of course, in 2020, remember when COVID started? Wasn't that long ago? Even the respected economists got their predictions wrong when they predicted significant drops in our property markets. And then in 2021, most of the economists didn't foresee how strong our property markets would grow again. So as a real estate investor, while it's important to have mentors, make sure you're listening to somebody who's not only built their wealth and owns a substantial property portfolio, but somebody who's kept their wealth in a number of cycles. I'm seeing them out again, though, these people making outrageous claims of what's happening who haven't been around long enough to have experienced this. There are just too many enthusiastic amateurs out there offering investment advice at present. They're back there again, buying 10 properties in 10 years or getting involved in property development, and you can make a fortune quickly. There's two types of information: stuff you'll still care about in the future, and stuff that'll matter less and less over time. Long-term versus expiring knowledge. It's critical to identify which is which, especially when you come across something new. The next lesson I'm going to share with you, but it's number 7, so I think this is going to be a longer episode than normal, is there's no such thing as the Australian property market. There are multiple markets in Australia. Each stage is at a particular stage of its own property cycle, and within each state there are multiple submarkets depending upon price point, geography, and the type of property. This means despite all areas enjoying the same interest rate environment, the same tax system, and the same government, some property markets will outperform others. Now, in the property boom, the once-in-a-generation property boom of 2020 and 2021, this wasn't the case. That was an unusual boom fueled by extremely low interest rates, pent-up demand, government stimulus, and almost every property around Australia, A-grade properties, C-grade properties, but good locations, bad, went up in value. But moving forward, you've got to remember that when people talk about the Australian property market, there isn't one, and local factors are going to drive our property market's performance more than ever. So avoid paying attention that gives broad generalisations about the Australian property market, or even the Melbourne property market, or Sydney or Brisbane property markets, because, again, when you look at apartments, there's the new and off-the-plan apartments, there's townhouses, there's villa units, there's the walk-up flats, old ones, ugly ones, and Art Deco ones. So one shouldn't generalise. The next lesson, number 8, is don't try and time the market. Even though we're armed with all the best research available in today's information age, look what's happened. The economists never seem to agree where our property markets are heading. And boy, they tend to get their forecast wrong. Now, not all economists, but many of them who are based in their city offices and work for the big banks and stockbroking companies, you'd think they'd get it right, but they don't really understand what's happening on the ground. And that's because market movements are far from an exact science. It's more than the fundamentals, because they're reasonably easy to quantify. It's more than the fundamentals that move the markets. One of the overriding factors that experts have difficulty quantifying is consumer sentiment and investment sentiment. So rather than trying to time your investment purchases or sales if you're looking to upgrade your home, if you buy the right investment grade assets, time in the market is much more important than timing the market. In other words, yeah, you may save $10, $15, $20, even $50,000 buying it cheaply, but if it's not the right asset, that's a one-off profit, as opposed to if you find the right location, the right sort of property, and one to which you can add value, and you get 1% more capital growth a year, the compounding effect of that is much, much more significant than the one-off profit. If you think about it, the top and the bottom of the market are really only, 1 or 2 days or 1 or 2 weeks or months in the cycle. Don't try and time the market. The next lesson I've learned over the years is that the crowd is usually wrong. Crowd psychology influences people's investment decisions, but usually in fact, often to their detriment. Investors tend to be the most optimistic near the peak of the cycle at a time when they should be more cautious. And investors and home buyers tend to be most pessimistic when all the doom and gloom is in the media near the bottom of the cycle like we are now, when there's actually the least downside. But market sentiment's a key driver of our property cycles, and one of the reasons why our markets overreact, they overshoot. That's why there was the FOMO, the emotion creating the recent property boom, and then they get too depressed during the slumps when there's the phobia, the fear of buying early. Remember that each property boom sets up the cycle for the next downturn, just as each downturn sets the scene for the next upswing. So beware of taking your financial cues from people who are playing a different game to you. Everyone's making a bet on their future, on an unknown future. It's only called speculation when you disagree with what other people are doing. But at the moment, there is mixed messages in the media. There is uncertainty. But as you would have heard me speak about in previous podcasts, I see 2023 as the year of the property market reset. But the crowd is going to be wrong and only going to recognise that's happened when 3-4 months, maybe even 6 months beforehand, beginning investors were getting in the market, experienced investors were getting in the market, home buyers were getting in the market, moving the market to the next level. But it takes a while for the results to be published in the media. It takes a while for median prices to start increasing again, auction clearance rates to rise. So there's the real market on the ground that we tend to know because our buyers agents at Metropole are on the ground the whole time. And then there's the perceived market, what the outside world and the media thinks is happening, which is usually 3, 4, 5 months behind. The 10th lesson I'd like to share with you is that property investment's a game of finance with some houses thrown in the middle. Strategic property investors have a finance plan to buy themselves not only real estate, but time. They do this by having financial buffers to see themselves through the ups and downs of the property cycle and give themselves the capacity to handle the fluctuations in interest rates. Now, I'm sure if you're a regular listener to this podcast, you know that at Metropole we put a strategic property plan together for our clients, and there's many components to it, but a large part of it is a financial plan, a plan for finance. And as I said, we help our clients buy time by not using up all their money, by having rainy day buffers to either cover their negative gearing or unexpected expenses, unknowns that come up. So having a finance plan is an important part of the strategy to see you through the cycle, because if you get through the ups and downs, in the long term, well-located properties keep increasing in value. So I guess maybe the next lesson I should actually say is you need a plan. So while the property markets will create significant wealth for many Australians, statistics show that 50% of those people who buy an investment property sell up in the first 5 years. And of those who stay in the game, the Tax Department every year releases how many Australians own investment properties and how many properties they own, 1, 2, 3, 4. It shows that 92% never get past their first or second property. I guess that proves what I've been saying for a long time, that attaining wealth doesn't just happen. It's the result of a well-executed plan. And you've heard me say before, the planning's bringing your future into the present so you can do something about it now. Now, just to make things clear, buying an investment property is not a strategy. You need a strategy, you need a strategic plan, but it's important to start with the end game in mind and understand what you need, what you want to achieve, how long you've got, what your risk profile is, what your financial capacity is, and then build a plan, a strategy to get there. That means the property or properties that you eventually buy will be the physical manifestations of a whole lot of decisions that you make, and you've got to make them in the right order. Property investment's a process, a long-term process. It's not an event of going out and buying a property. So if you're a beginner looking for a time-tested property investment strategy, or if you're an established investor, maybe you're stuck because of the change in finance at the moment, or maybe you just want an objective second opinion about your situation, I suggest you allow the team at Metropole to build you a personalised, customised strategic property plan. Because when you have a strategic plan, you're much more likely to achieve your financial freedom, what you're looking for, because we actually help you define your goals. We help you see, are they realistic, especially for your timeline. We discuss how your progress is going, because if you're a beginning investor, that's different, but if you're an established investor, is the property portfolio you've got working for you or not? Is it going to get you where you want to go to? We'll also talk about ways of maximising your wealth creation, identifying risks you haven't thought of. And the real benefit of having a strategic plan is you're going to be able to grow your wealth through your property portfolio faster and more safely than the average investor. Now, if you're interested in getting my team at Metropole to help you make 2023 a great year in property for you, go to metropole.com.au. I'll leave a link in the show notes, and why not discuss your options with us? Now, just to make it clear, there's a lot of people out there now calling themselves property strategists, but our plans are very, very detailed. It's not just buy a property or what price bracket or which suburb. It includes an asset accumulation strategy, a manufacturing capital growth strategy, very important at this stage of the cycle when there's not as much natural capital growth. We have a rental growth strategy as part of the plan, an asset protection and tax minimisation strategy, as I said, a finance strategy, including a long-term debt reduction strategy, and a living off your property portfolio strategy. So the strategic plan, very detailed, often over 100 pages. But if you're not a detailed person, you can read the summary. But we're going to take you through it, work you through it, help you. Metropole.com.au. Leave us your details and let's discuss your options. Now, back to my 22 lessons that I learned in 2022 that I want you to remember. And the next one, number 12, is invest for capital growth. In my mind, that should be your key driver for your investment decisions rather than cash flow. Sure, cash flow is important and will keep you in the game, but it's capital growth that gets you out of the rat race. So yeah, you need a combination of both. Smart investors build their equity first, and then they convert it to cash flow. At Metropole, our 40-year analysis of investment returns show that properties with higher rental yields generally deliver lower capital growth over the time and therefore lower overall return for investors. Our analysis proved that over the medium to long term, properties with lower rental yields, but the ones that have stronger capital growth, delivered significantly higher overall returns. In other words, capital growth and rental growth. While cash flow positive properties with higher rental returns delivered lower overall results. It's just too hard to build a significant property portfolio out of cash flow that's taxed or out of properties that don't have as much capital growth. What this means is those who invest in the more affordable suburbs that deliver high levels of rental return and they expect to get strong overall growth, they actually end up achieving exactly the opposite result. It also highlights the significant opportunity costs of having underperforming properties in your portfolio. Think about it, if you can only afford, 2, 3, 4 properties, you've got to make sure that they're investment-grade properties and that they're working hard for you. Moving forward, I can see that we're going to have a two-tier property market. As markets pick up during 2023, they're going to be more fragmented. It's likely that higher interest rates and inflation, and they're going to stay around for a while. So while they're going to peak, they're not going to suddenly drop quickly. We're going to take a few years for inflation to come into the target range of the Reserve Bank. Once the Reserve Bank's told us that interest rates will stay high-ish. Hey, this is normal rate, though, for a while, but that's going to keep eating away at the average Australian's household budget for some time, making property less affordable for many. Of course, it's a big country, and there are many remote locations where properties remain very affordable. The problem is, that's not where people want to live. If coronavirus taught us anything, it taught us the importance of living in the right property, in the right neighbourhood. In our new, let's call it COVID normal world, people are going to be prepared to pay a premium for the ability to live, to work, to play within 20 minutes, bike, ride, drive, walk from home. They're going to look for things such as shopping, businesses, services, education, community facilities, recreation, sporting resources, jobs, all within proximity to their home. Let's call it a 20-minute neighbourhood. Residents of these neighbourhoods are going to appreciate getting out and about in the street and socialising and supporting local businesses, being involved in local schools, enjoying the parks. But as I said, as obtaining finance becomes more difficult moving forward, it'll be people with more money, higher incomes that are going to drive property prices moving forward. Our markets are going to be fragmented. Now, this is not a judge of people, but it's just a fact that some people with rising mortgage costs, rising cost of living but wages not keeping up, and some first home buyers who are going to want to get in the market but find it harder because of affordability issues and even the fact that their rents are rising so they can't save as much deposit, they're going to be out of the market, while those with multiple streams of income and higher wages are going to be able to keep pushing the value of properties in certain locations up. I guess this also brings home the point I made a moment ago, that you've got to make sure that the properties you own are in the right location, and part of the strategic property planning service that Metropole provides is seeing, are they the right properties, or do you have to make that difficult decision and get rid of an underperforming property? Now, the next lesson I'd like to share with you is there's always going to be reasons not to invest. Every year brings its own set of crises and lots of reasons not to invest. You can go back as far in history as you like. We'll never have a crisis for a year. Sure, some years are worse than others, but there's always bad news and much of it's unexpected. Where investors get into trouble is rather than focusing on their long-term goals, they see these crises as once-in-a-generation events that are going to alter the course of history, when in reality, they're just the normal path of history. Easy for me to say, having been through so many cycles. Same with our team. We're able to give a more strategic, holistic advice because of the perspective we can offer. The next lesson, and it sort of follows on from what I was just saying, it's lesson number 14 of our 22 lessons, is property investment is risky in the short term, but secure in the long term. Last year reminded us, many property investors, that real estate isn't a way of getting rich quickly. Last year reminded us property values don't always increase. But this is the way the market behaves. Looking back, there were long periods of times when the property markets in each state at different stages didn't increase. Remember, I said it before, each markets in each state's in a different stage of its property cycle. The previous peak was 2017, and there was a long period between 2017 and October 2020 when the recent boom commenced, where property values hardly went up at all. Property markets remained flat and, in fact, fell in many locations. Yet those who stay in the game benefit from the power of compounding growth, which builds wealth. But that takes time. Remember, every past decline looks like an opportunity when you look back in the rear vision mirror, but every future decline, or the one you're in at the moment, looks like a risk. See, I found it takes the average property investor around 30 years to become financially independent. Now, I know that's not what you want to hear, but you're going to need to build a bigger portfolio of assets and not just properties. There's the strategic property plan that we offer our clients at Metropole is more than just property, because you may need money in your super fund or share portfolio. Anyone who just says property only or shares only, you should run away very quickly. But the point I was starting to make is it takes the average investor 30 years to become financially independent. And those who don't make it, that's because they can't stay the distance, in part because they haven't got good cash flow management. Many people get into property to improve their cash flow position. They want to buy a property because they haven't got enough cash flow. That's not the way property works. And if they don't have good money habits to start with, taking on more debt to buy property often only compounds the problems. The 15th lesson I'd like to share with you is plan for the worst and look forward to the best. As a property investor, I protect myself from the challenges of our property market by owning the right assets, investment-grade assets in desirable locations, having multiple streams of income from a diversified portfolio. I've got residential property, commercial, industrial, as well as shares, as well as my super fund. I own my assets in the correct structures that protect my interests and are tax effective. I have set up financial cash flow buffers, like I explained a moment ago, to see me through the challenging times, and I've protected myself and my assets by adequate insurance policies. So, as I said, plan for the worst and look forward to the best. Fortunately, I didn't need to rely on most of those protections that I put in place long before the current challenging times, but having them in place helped me sleep much better. You see, I learned to protect myself and my investments because I don't make forecasts. Instead, I have expectations. Now, there's a big difference between forecasts and expectations. I expect there's going to be another recession. I don't know, probably in the next decade, but I don't know when it's going to come. I expect the property market's going to remain flat for a little while longer, and then the next cycle will pick up again. but I don't know exactly when. I know there's going to be another property boom, but I don't know exactly when. I expect some of the investments I'm going to make probably won't work as well as others. I don't know which they're going to be. I expect interest rates to once again drop back a little. Probably not for a while. In fact, I don't really know when. I don't think the Reserve Bank does either. I expect the world will have another financial crisis, but I don't know when that's going to come. Now, these aren't contradictions or a form of cop-out. As I said, there's a big difference between expectations and a forecast. An expectation is the anticipation of how things are likely to play out in the future based on my perspective of how things have worked in the past. A forecast is putting a time frame on those expectations. Of course, it would be ideal to be able to forecast what's ahead for our property markets with a better level of accuracy than I've just given you. But we can't. There are just too many moving parts. Sure, there are all those statistics that make it easy to quantify, but as I explained to you before, what's really hard to quantify is exactly how millions of strangers are going to react in response to the prevailing economical and political climates. And as I also mentioned, there's always going to be X factors that crop up. So as I said, I plan for the worst, but expect the best. Planning is important, but the most important part of every plan is to plan for the plan, not to go according to plan. The 16th lesson I want to share with you today is that you can't rely on one stream of income. You've probably noticed that successful investors, business owners and entrepreneurs enjoy multiple streams of income. They strategically go to great lengths to make sure they've got money coming in from all directions. Or in other words, they don't have all their eggs in one basket. Unfortunately, many Australians learned this lesson the hard way during the years of the pandemic, some losing their jobs, others having their work hours cut back, and yet others losing their life savings as their small businesses went broke. That was a terrible time. But there'll always be issues to contend with. It may not be a pandemic next time. It could be personal health. It could be your inability to work. Sure, it's hard enough for some people to figure out how to create a single source of income, let alone multiple sources. But in my mind, you've got no choice. Rather than relying on your job as an income source, become financially fluent, learn to invest, and develop multiple streams of income. Now, if you're at the stage of your life where you've already got a portfolio and you want to take it to the next level during the challenging times, but great opportunity times that we've got ahead, why not join me in the best faculty I could put together at Wealth Retreat on the Gold Coast at the end of April this year? It's a small group of people where we will help you plan the next 5 years of your life, because a lot of people who come along are already very successful, but they seem to feel isolated. They don't have many people to share with or experience, so the networking opportunities are great. You're going to learn a lot from the faculty, but you're also going to learn from the people you have breakfast, lunch and dinner with, because everyone leaves their Superman capes at the front door, and it's a fantastic opportunity of joint venturing, networking, getting together with other successful people. But I start off by, I guess I give you my mentorship program on steroids and upgrade your wealth operating system. Because once that happens, then we can give you a toolbox full of tools to help you achieve the goals you set. And we help you plan, make you plan where you're going to be in 5 years' time in all areas of your life. Not just property, but relationships, business, health, recreation, spirituality, contribution, family. So why not have a look at Wealth Retreat? Go to wealthretreat.com.au, and I speak to everybody who joins us on purpose to make sure it's going to work for you, that you don't invest 5 days and waste it, and also because I personally guarantee your attendance there, so I want to make sure it's going to be the right thing for you. wealthretreat.com.au. Now, I'll leave a link in the show notes. Lesson 17. There are always risks associated with investing. But in the regular podcast you've been listening to these, you know that I warn you not to be afraid of failing, because the biggest risk is not doing anything to protect your financial future, not investing because, hey, what if it goes wrong? Sometimes negative experiences, mistakes, failures can be even better than a success because they teach you something new, one which a win would never teach you. As I've said, I'm a real success at failure. However, we're often so driven to get things right that we fail to see the value in the things that we get wrong. So instead we spending our time wishing we would have done it differently, or not done anything at all because the fear of making a mistake paralyzes us. If you get it wrong, learn from your mistake. Make it count by doing the better doing it differently next time. One failure can, with time, create many successes. So risk management is less about how you respond to risk and more about recognizing how many things can go wrong before they actually do. Lesson number 18. As we're getting almost to the end of the list, I hope you're enjoying this. I'm having fun talking with you about it. Lesson 18 is cautious optimism is better for your investment health than perma-pessimism. Look, life's not fair. Get used to it. But having said that, optimists are more successful in all areas of their life than pessimists, or so-called realists who are really just pessimists in disguise. And this includes the realm of investing. Now, this doesn't mean you will necessarily be happy and smiling all day, but it does mean you've got an ability to look at a situation and while it might be tough, you're able to see around the corner, you're able to see the possibilities rather than just the difficulties. Those who've got high expectations usually rise up to meet them. Pessimists always seem to sound smarter in the short term than optimists because optimists sound like a sales pitch while pessimists sound like somebody trying to help you. Boy, do we see that a lot with the trolls on the internet. As we get into the last couple of lessons I want to share with you in this rather long podcast, but I hope you're enjoying it, is time is a limited resource, so don't waste it. We've all got 1,440 minutes a day, but some of us squander it, waste it, don't use it efficiently. Living through over 260 days of COVID-related lockdowns in Melbourne reminded me how truly valuable time is. You can lose money. You can get it back, though. If you're sick, you can often get your health back. But once time's gone, it's gone. It's irretrievable. So start to capitalise on your time, the time you've got, and get a whole lot more done. The problem is most people confuse moving with progress. Just because you're doing a lot doesn't mean you're getting a lot done. I found many people seem to be running in the same place. Interestingly, working from home has made me a lot more efficient. I get a lot more done in the 1,440 minutes I have every day. Another way of looking at time was brought home to me in 2022 last year, and that's that life is short. On some level, most of us know that life is short, but 2022 taught us and solidified the fact that we don't get a second chance, and the importance of truly appreciating what and who we have in our lives is important, so live your life to the fullest. The 20th lesson is the only certainty is change. Now, we all face change every day, whether it's as simple as changing in the weather or something as significant as another wave of coronavirus that seemed to come back at the end of last year. Changes are a normal part of life. The problem is, most of us don't like change. We like certainty. However, learning to expect change has brought me hope during the challenging or unexpected life events that I've experienced, and I've experienced more than my share. I've come to realise that it's not the circumstances or the changes that dictate how my life is going to go, but rather how I handle those changes and disruptions. Rather than worrying about all the changes occurring, I've learned the concept of having a useful belief. I learned that from Chris Helder, a great Australian coach, who taught me the importance of having a useful belief about changes that are happening to me and seeing what good will come from them. You see, the more I feel in control of my life, the more comfortable I feel, and the better I perform in all areas of my life. The second last lesson I'd like to share with you is worry better. Fact is, most of the things we worry about that we fear never happen. They're just monsters in your mind. And if they do happen, they're most likely not to be as bad as you expect. But forget the saying, don't worry, be happy. Instead, worry the right way. It's better than not worrying at all. You see, worry can play an important role in your life, and it doesn't have to be destructive. We're wired to worry. That's because worry's got an evolutionary benefit. It drew our attention to the fact that there were some things that we should be doing and other things that we shouldn't do, that we should avoid. Those who worried correctly, they survived, they evolved. But today, time spent worrying is time that you could spend identifying opportunities or taking action. Worrying about the right things can motivate you, but if you find it unproductive, try to take your mind off those things but by engaging in activities that are going to excite you. I've learned the trick of limiting the amount of time I worry. I was taught this concept of telling myself to put a time limit of, 5 minutes, 10 minutes on worry time. and then forcing myself to move on by focusing on other tasks, engaging in other activities. It's a good trick to learn. Okay, I'm angry, I'm cross, I'm worried, I'm scared. I'm going to worry for 5 minutes. Okay, time's over. Now get on with it. And the last lesson I want to share with you today, the 22nd lesson, is this too shall pass. How often have we heard that the world as we know is coming to an end before we realise the world as we know it has not come to an end? I've learned that making long-term decisions based on short-term concerns isn't a recipe for success. So what's the lesson here, I guess? 2023 is going to bring its own events that are going to dictate our lives and our financial markets. So I recommend you prepare for those and just see them for what they are, a distraction. There you go. I've just shared with you 22 lessons I've learned or relearned in 2022. And I'm looking forward to this new year, 2023, because I see this as a time when the property market will reset. I've noticed that in the past cycles, this is the stage when lifetime wealth was created because people got in before the crowd knew what's going on. Now, I already told you, don't time the market. So we're not going to suggest you do that to time the market. But if your circumstances are right, this is a great time to upgrade your home because the more expensive houses have dropped more in value than medium-price houses. So if you're interested in buying a new home or an investment property, why not have a chat with my team at Metropole? We help a lot of home buyers. Well, I was going to say level the playing field, but we actually stack the odds in your favour by having a great team on your side looking after your interests. If you're keen on getting involved in property investing, think about that strategic plan. And if you're really serious about making the next 5 years of your life ones that are going to change your destiny forever, join us at Wealth Retreat. Just go to wealthretreat.com.au. I'll leave links in the show notes for all of those things. Thank you for spending the last, almost 3/4 of an hour with me, just you and me. Back to a normal show with a guest real soon. But some great lessons to learn from 2022. Thanks for allowing me to share my lessons with you today. If you got some benefit from it and you don't already subscribe to this show, please use the app that you're listening to this on. There's usually a follow button. It used to be called subscribe, but since you don't pay, they're saying it's no longer a subscription, it's actually a follow. So follow this show so you can get my regular show that comes out twice a week. And I have a heap of guests lined up for 2023 that are going to bring you the perspective that you need to get clarity and direction in our changing property markets. Of course, you can catch me in between shows on social media. Just look for Michael Yardney on social media, or you can join my private Facebook group by going to the Property Update private Facebook group. Now, I've got a bonus for you, a way of saying thank you for listening to this show. Go to podcastbonus.com.au. I'll leave a link in the show notes and you'll be able to get a heap of ebooks and reports. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?